so, given the cracking year and indeed era that we've had in this business. Today we move more to the look forward. What do we think the future holds, and how would we like to define success, both longer term and indeed shorter term. So we're going to walk through, myself and that esteemed leadership team, walk through our objectives and our initiatives for the next 12 months and indeed beyond. So we're unashamedly moving into forward-looking mode. See, we've got standing room only. I'm told that we're competing with the Usain Bolt semi-final. Thank goodness it's not the final, otherwise I'd probably be speaking to about 3 of you. But appreciate your interest. The first thing to cover off, so Vinna, you and I have, completely rehearsed all this. Next slide, please, is before we get to the shorter term in terms of what do we define success as being in 16 and 17 and what are the initiatives we're going to put in place to enable that success over that 1 year period, I think it's really important to remind ourselves as, what's our longer term aspiration for this business? This is really, I think, critically important. It's important for us, and it's important for all of the people that we serve around the world to be clear on what we're trying to do and how what we're doing on an every daily basis aligns to the longer term strategic intent of this organisation. And we want to be the world's most trusted institutional funds manager, meeting and exceeding client objectives and a brilliant place to work on behalf of a truly global collective. Pretty long sentence, maybe a bit inelegant, but really important. We want to be the world's most trusted. And that's with the partners we sit beside with in various investment vehicles. It's with governments that we engage with. It's certainly with clients that are dealing with us or considering investment. We want to be always outperforming. Whilst we've been set up for a noble intent and we're different to everybody else, at the end of the day, we want to be renowned as being the fund manager that meets or exceeds client objectives. And we want to be the world's most trusted institutional. We don't want to be retail, we don't want to be mezzanine, we don't want to be platform, funds manager. We don't want to be an advisor. We don't want to be an investment bank. We want to be the world's most trusted institutional funds manager. We don't just want to be the infrastructure fund manager. We want to lead on that, but we want to be able to meet a broad range of client objectives and support them across a range of asset classes that will enable their underlying working people, members in this country, working people around the world, to get to retirement and afford it. So we want to do a world-class job, not just in the asset classes that we are most renowned for, but across all parts where we believe we can bring a competitive advantage and outperform. And a brilliant place to work. If you want to work in funds management, you either do work for IFM or you want to work for IFM. And on behalf of a truly global collective. That is, we are representing ourselves like we are with governments around the world as they contemplate what they need to do to grow their GDP in whatever parts of the world. They're engaging with people like us because we represent a different form of capital. There's lots of capital around the world, lots of capital. Not a lot of it sitting in public institutions, but a lot of it sitting in private institutions. We don't just want to be capital, we want to be a different form of capital, that truly global collective that thinks and acts in a long-term responsible way, optimising returns for investors and at the same time adding to the economic prosperity, which drives us to our next point. There's lots of reasons for being, but ultimately we believe that we want to create genuine prosperity. Now that sounds a little noble and idealistic, but I think the world would be a better place if IFM managed more of its money. That sounds a little arrogant, but I mean it, because in an environment where there's somewhere in the vicinity of about $70 trillion sitting in either pension funds or insurance companies or sovereign funds around the world, whilst we can be proud of our success, we manage $71.6 billion of that $70 trillion of contestable assets. I think the world would be more prosperous if we manage more of it and other managers that have less alignment and less skill than we have continue to manage the money that they've got. The world would be more prosperous if a truly aligned manager that has the skill base and the global reach that we've got and the motivation that we've got actually manage more of its money and will invest it back into productive enterprises, be they listed or unlisted, to create jobs, to create growth, to reduce carbon emissions, to have a fundamental social impact, not just an economic impact. The world would be more prosperous if IFM managed more money for it. So we are unashamedly very focused on continuing to manage all that we've got really, really well, because we'll only get the right to manage more of it if we look after what we've got. But we are unashamedly focused on making a greater contribution to the global institutional investors around the world that are aligned to our values to ensure that their underlying working people, be they members or whatever else, get to retirement and have a dignified one. And the world would be a better place if IFM did more of that. So, the themes that have been driving our strategic planning process have been in place for the last 6 years since the then board and then leadership team said, what are the 4 themes that really should frame our strategic thinking? We first and foremost want to respect and retain our heritage. We are globalising, we are growing, we are retiring, we are remunerating. We're doing all of the things that you need to do to be on the march towards being that world's most trusted institutional funds manager. But we'll do that in the context that our heritage is critically important to us. We are different. We are one of the few, if not the only, funds managers in the world that is owned by pension funds. That drives a different culture. And that culture is critically important to us. It's a source of sustainable competitive advantage. All of those that have been to management school that's the holy grail. Get it and hold on to it. We've got an ownership model and a culture that is distinct, is different. We want to respect it, we want to retain it as we grow, as we globalise, as we retire, as we remunerate, and as we do all of the other things that need to be done to advance us towards being that world's most trusted institutional funds manager. We wanted to strengthen the resilience, stronger, more robust relationships with our clients, a truly engaged group of people working for us, really responding to what it is that you think we need to do to create that truly brilliant place to work. We wanted to make sure that our portfolios were stronger, cleaner, of the highest quality, be they unlisted or listed. We've done a lot of work on really building not just the quantity of results, but the quality of results, the strength of relationships with clients, the quality of our portfolios, the quality of engagement with people, and certainly the quality of our P&L. We are much stronger now financially and have therefore greater financial and strategic flexibility to do the things that align to adding to the returns of the working people that we look after. We wanted to diversify, but we must be selective in that. If we are only going to be an institutional funds manager, we don't want to deal with retail clients, not because we don't like them, but because we want to have the capacity to invest for the long term and do what we think is the right thing to do to optimise their returns, rather than be whipped around by the sentiment of retail investors, with great respect to them. But they are renowned for buying high and selling low. And that's not how you make long-term money for investors. So we will diversify, but we will politely say no to people that want to work for us, to products that we don't believe that we can do, to pricing structures that we don't think are truly aligned, to investments that we don't think are going to add to clients' returns, and of course to clients that we don't think are that long-term aligned institutional investor. And we want to globalise. The world is a very big place, lots of pension funds and sovereign wealth funds and insurance companies in a low return environment looking for returns. Let's globalise. Let's globalise, because with that scale, there'll be benefits back to Australian investors and Australian members. We're able to do things. We're able to attract and retain talent. We're able to get access to a world-class global network. We're able to buy larger, better quality assets, which in turn, that global benefit comes back in the form of increased returns and better value for money for our investors here in Australia and indeed around the world. They're the themes. The market trends that are otherwise gone into our thinking, lots of issues to contemplate. The bottom line is the one that's probably most important. We are aware of and alert to the risks. There's always something that can go wrong in funds management, particularly when you're managing nearly $72 billion, particularly when you've got people in now 7 offices around the world speaking 16 different languages and across all of the time zones. When you've got multi-currencies, there's things that can go wrong. We need to learn from that, not be fearful of making mistakes, but absolutely minimise the likelihood of them happening. But when they do happen, because they will, ensure that we learn from them. Having said all that, whilst there's risks and things that we do worry about, in an environment where we've got the Bank of England with interest rates, what, at a 325-year low or thereabouts, interest rates in this country at a 70-plus year low, it is truly an extraordinary environment, amongst other things dictated by that low return environment. In a low return environment, institutional investors around the world, be they pension funds, super funds, sovereign funds, insurance companies, are looking for skill, alpha, value for money and alignment. And we bring all of those things. Now, other managers would argue that they bring all of or part of those things, but nobody really brings the alignment that we've got, which adds to the skill that we've got, which adds to the alpha that we can deliver in a sustainable way in the value for money that we do. So in the environment, if you think that it's going to be lower for longer, there is an absolutely fantastic opportunity for a firm like IFM to add more to the retirement savings and other savings of institutional investors around the world like never before. So there are risks, there are things that we worry about, there are things that will hurt us, but the upside for this business far outweighs the downside in the environment that we're in. A truly aligned, skillful global manager like IFM delivering the value that we deliver is an outstanding spot to be in the environment that we think institutional investors face around the world. So, with that, we put to our board just, what's today, Tuesday, these objectives, and we didn't have to change any of them. Was it remarkable? Normally we have to change a threshold or a stretch or a MET or whatever else. The board accepted this business plan. Now, there's been a lot of collaboration with you, with the board, with our investors, with the extended leadership team globally. And by the way, I should welcome Tokyo and Sydney and indeed Hong Kong. My apologies for doing that too far into the presentation, but there's been lots of consultation globally about what we think success could and should look like. Product performance remains the dominant focus. 55% of our balanced scorecard is weighted towards investment performance. Philip in particular has done an enormous amount of work. We've consulted with the leadership team on how we came to these numbers, and we're more than happy to share that. Our MET objective is 87% of the 16 products that are in the universe, because we've got slightly less this year because we've got one private capital rather than all of the private capitals because of the fund-to-fund nature of that and our ability to control that. Board accepted all of that. So 87% of our products to achieve their rolling 5-year returns after tax, after fees. If you want more granularity around that, we are more than happy to provide it. We're quite comfortable, well, I won't say comfortable, we're quite confident in the likelihood that we could achieve that and potentially even achieve stretch, which is 100% of the 16. Because where we've got multi-products, we actually have, what do we call it? Composites. Thank you. That makes sense, doesn't it? Composite is a composite of a whole lot of other things. So product performance, 87.5. The next one is around net flows or FUM targets. Subject always of some discussion. Bottom up, top down, sideways in, every asset class. Net flows after gross, after redemptions, all that sort of stuff. We did 7.62 this year. We had some extraordinary positives in that. We also had some others in that. Net, we think that 7.9 billion of net flows over the course of the next 12 months is eminently achievable. Right, Ger and everybody? I just wanted to make sure that there was a high level of enthusiasm for that, because but it's tough. But in an environment where there's you look at in this country, what's the biggest allocation that people have got? It's to listed equities. Are we getting our share, given the quality of returns that Aidan and the team have delivered for 20 years? Given the active capability that we've now got? Given the global equity capability that we've now got? I think there's an enormous opportunity. There's a few investments going on in infrastructure. If you're reading the newspapers at the moment, there's a distinct possibility that there's further opportunities that open up for our investors and indeed for our fundraising as a result of that, only if it meets our investment criteria, of course. From a customer advocacy perspective, we achieved an off-the-chart, quote-unquote, result this year, 8. We've looked at that. There were some extraordinaries in that, particularly around the Pacific Hydro sale. One year I'll come here and we won't mention Pacific Hydro, but at least I'm mentioning it in the positive now. As a result of that, expecting an 8 advocacy in the future would be unreasonable on us all, and virtually very difficult to attain. So our stretch is actually 7.8, even though we achieved 8 this year. So again, we've done a lot of arithmetic work with the providers there, put our own judgment over it, discussed it with the leadership team. They're our numbers for customer advocacy. Financial margin, you'll see it's actually coming down from 19.1 to 16.9, and that's because our P&L is actually shifting. Our objective here is based on the operating margin of the business. We then have a statutory profit that sits underneath that, and that's after performance fees come in and carries go out, and it's after strategic initiatives and all that sort of stuff. So our statutory margin continues to increase. So our bottom line is increasing, which is what you'd expect. Our operating line is actually shrinking, but that's somewhat deceptive. It's more because of how the mix is flowing through the operating versus the statutory. Again, happy to explain that, or Philip would be in greater detail. And employee engagement, this year we achieved 76.84. We want to continue to respond to your feedback. We wanted to continue to advance towards that brilliant place to work. But at the same time, we want to set a reasonable set of objectives. And so 74 is the number that we've agreed on this year as the MET, with the stretch at 77, just slightly above the 76.84 that we achieved this year. So there's some difficulties in that. There's some greater flexibility, for want of a better word, in that. But we think that after a lot of consultation and a lot of analysis and a lot of engagement there, that's an eminently achievable scorecard. We did 95.7 this year, as you probably all well know. Let's aim up for that sort of result again next year, and I think those numbers, there'll be some stretch in that, but eminently possible. So, our 8 initiatives. How am I going, Vinny? You haven't gonged me yet, but you're just about to. The 8 initiatives, we're going to have the leadership team spend some more time on these, so I won't do too much at this point in time. Accelerate globalisation. In essence, we've put an enormous amount of effort into our investment management capability, adding capabilities in terms of asset management in infrastructure, adding global enhanced passive and global smart beta, adding Australian active. So this year is less about investment management capabilities and building that out, and more around taking the capability we've got to the world. And that starts here in Australia. There's an enormous opportunity here in Australia. 6 of the top 10 superannuation funds in this country are not currently clients of IFM. And there's a whole range of other... We've got a fantastic client base here, but there's more that we can do in Australia. And there's certainly more we can do around the world. So we are unashamedly focused on GER and globalising our distribution reach, given the great investment management capability that we have in this organisation across all of those 4 asset classes. Focus on active listed equities. Neil's going to talk to that. Retain and enhance culture. Josh is going to talk to that. But I must stress, as the CEO, culture is just so critical to every organisation. It's absolutely fundamental to this organisation. And we will continue to be overtly and unashamedly focused on ensuring that we enhance and sustain and grow the brilliant culture that I believe we've got in a manner that is also cognizant of the global marketplace that we're competing in. Grow private capital. Steve has done a fantastic job in redesigning the model, elevating the capabilities within the team, extending the advisor network. Great opportunity for us to add alpha to clients' portfolios through a much more innovative and well-skilled and well-resourced private capital capability. Extend and expand infrastructure. Please, first priority, 32 billion that sits in 2 pools. Anything and everything we do will be cognizant of the responsibility to that group of people. Having said that, is there an opportunity for us to look more broadly along the risk-return spectrum, or otherwise along the product spectrum, in a way that provides complementary, not competitive capital to the existing $32 billion that's sitting in our infrastructure funds around the world? Operating efficiency. We've grown, we've bureaucratised to some extent, we've built capabilities out. We don't want to take costs out. It's not a cost reduction program. It's just, let's have a look at the things that have been building up in our system so as we can be more efficient, just as effective, and redeploy some of those resources to things that are going to really add value, because there might have been just a little bit of bureaucracy creeping in unintentionally. Now's a good time to have a look at, can we simplify? ESG, Chris is going to walk through that, but in a world that in particular is focused on democracy rising up and having a say against institutions, how can we differentiate ourselves in an E, an S and a G perspective? And broaden our global equities capabilities. Aidan and the team, unbelievably compelling story there. 4 sources of competitive advantage. Fantastic that we've got 500 million sitting in it, but compared to the opportunity to really add to clients' returns in global equities around the world, we've got an enormous amount of upside. So there are our initiatives. I have to also briefly speak about, on behalf of Brian Clark, who now heads our global investor relations team. And you know, the important point here is that we want to globalise our investor relations, so we've moved from a local to a global model, hence the appointment of global head, hence the appointment of Brian. We want to bring a high degree of nuance to the different regions, but at the same time have a consistent and world-class approach to our client servicing and our sales efforts. And we want to make sure that we better resource that team with both service, sales and other operational capabilities. And we want to make sure that there's a strategic approach across all of the asset classes to ensure that if there's an opportunity for us to add more to an institutional investor's returns around the world, we're doing that, and we're unashamedly growing and diversifying our business in the process. So that's really about, as I said a moment ago, recognising that we've put a lot of effort into, and we will always focus on continuing to improve our investment management capability, but with a number of relatively new initiatives, locally and globally, let's look at taking those initiatives and those capabilities to the world and making sure that we're making an even more profound contribution to our institutional investors' total returns through us having more of an involvement in their asset allocation and product selection. So with that, I will. We're going to keep going and let you reserve all of the multitude of questions that I'm sure you'll want to ask at the end. But with that, I'm going to hand over now to Josh Lim and Peter Ellingson, who are going to talk about the retaining and enhancing culture.
Okay. Hello, I'm Josh. I'm the new Chief People Officer. Can you hear me? It's good? Okay. So I was thinking about people when Brett asked if I could head up the people and culture team, and I obviously accepted. Why? Because people and our employees are the most important asset of this organization. So you know, that's I think a pretty plain statement. But given that most of you are accountants, because by weight I think there's a lot of people from FinOps here, and given that there are quite a number of investment staff here, numbers, you know, I think are really part and parcel of your toolkit. I'm a lawyer, so I'm not good at numbers, so I'm going to use a accountant's story to describe people. Now this is, I'm looking at Philip here. We have not rehearsed this, so this could go very badly. So Philip, what's the net asset value of IFM? Net asset value? Yes. 65 million is the net asset value of IFM. What's our valuation? 511 million. What's the delta? I can't subtract. What's the difference? Yeah, between the two? About 435. 400. Let's call it 400 million. 400 million. That's not in our books. I don't see it as an asset in our books. What's that? I think that's you, isn't it? You're worth 400 million collectively. Some more than others. I think Brett's worth 150 million. And for us, the rest. But look, the point I want to emphasize is you are actually pretty important to this organization. We don't have a balance sheet, to be honest, 60 million. We're not a bank. If we lose you, that's the end of the organization. So with that in mind, I want to get Peter to say a few things about some of the initiatives that we've put in place. Then I'll come back and I'll touch on culture. But as a strategic initiative, the reason why this is number one is because you guys are the number one asset in our organization. So Peter, to you for a moment.
Thanks, Josh. Morning, everyone. So as Brett alluded to and Josh mentioned, culture is critical to any organisation, but particularly to IFM. Given our roots, given where we've come from, there's a few things we know. We know that our culture is truly unique. We know we've got a fantastic culture. And as Josh just said, we know at the heart of our culture is our people, and it's you. So to that point, the challenge for us, or the continuing challenge, is as IFM grows, becomes more complex, becomes more globalised, how do we retain that core part of the culture that is our reason for existing, and how do we flex and change to adapt our culture as we continue to grow? So to that point, and these won't be unfamiliar to you, but there's three key parts of this strategic initiative that we've been working on over the last couple of years. And it's really around growth and culture. As I said before, how do we maintain as we continue to grow? It's around reward and retention. So how do we leverage those levers to continue to attract the right people who are culturally aligned, motivate all of you who are in the organisation and are culturally aligned, and retain our great people as well. And finally, around leadership. And leadership just doesn't apply to this group sitting in the front row. It applies to all of us, whether we're individual contributors, leaders of people, or leaders of teams. And how do we continue to build our bench strength as an organisation? And for our great people who are culturally aligned, allow you to continue to progress in your careers. So what's been done in the past across these three key areas, and I won't go into the detail, but a lot of what's been done in the past is foundational. A lot of it's behind the scenes. You won't have seen it or felt it, but it's certainly impacted all of you across those three key areas. Moving forward, what's next? And again, under these three broad headings, we won't go into a lot of detail. What we're going to do instead is pause, reflect, and go away and recalibrate based on the impetus now on growth and culture. But there's a few things in there that we're planning that again will impact you. Where we've gone from foundational and largely behind the scenes in the past, this year will be more tangible. You'll be able to see it and feel it a lot more. So we're excited to be able to drive this strategic initiative and hope you will be too. Thank you.
Okay, just to finish up, there's a ring around culture because we do want to put some focus on culture, not to the exclusion of the other two initiatives, but really to emphasize what Brett had indicated earlier. Culture is important. How we're going to go about it, I'll announce that later on, but I think it suffices to say that I want to have a conversation with each one of you if possible, and we'll put some forums in place. And I want to talk to you about what your view is about IFM and our culture and why we're here. You know, we get paid, of course, you know, we turn up for work, we have a family to feed, all that, but at the heart of it, you know, why are you here at IFM? So rather than me going into a lot of detail, I just want to put that as a placeholder, and you'll hear a bit more about that from myself and the PNC team. Thanks, Vina.
I think Brett's right. There are a few new faces in the room as I look around. So I'm Steve Lipkin, for those of you, and it is pronounced Lipkin. You can say Lipchin if you want to, really. But officially it is Lipkin. I see the slide says grow private capital, but our initiative in private capital has really been largely about transformation over the last couple of years. We're clearly going into the growth phase now, but I wouldn't say we've fundamentally grown. We have fundamentally transformed. I think, to put it succinctly, what we've transformed from is effectively from a limited partner investing in other people's private equity funds to a general partner investing in other people's companies directly. So we really are positioned in the marketplace more alongside GP names that you would be familiar with, the Archers, the Quadrants in Australia. We really view ourselves as a player. Being able to hold our heads up and work alongside and compete against those GPs, and no longer really as an LP. So we've kind of changed our sense of who we are. Our initiative, and it really is a 2-year initiative, and again, this transformation wouldn't have been possible without the support of the broader organisation, the leadership team, and all of you in this room. And it really has been a journey and a very fulfilling journey, certainly from my perspective. But the initiative itself really has sort of two key objectives. One of them is to develop pipeline, and the other is to develop capacity. I sort of came up in my mind with a simple equation for how you deliver alpha in private equity this morning, and it's really pipeline plus capacity equals alpha, and it's pretty simple, but that's how it works. Pipeline is different from deal flow. A lot of people get confused between deal flow and pipeline. So pipeline is a much richer concept. Pipeline is inventory. I'm looking at Philip because he's the accountant. It's work in progress. It's a rich vein of opportunities that we can draw on in an institutional fashion for a long time to come. It takes a while to develop. Deal flow is sort of an easier concept. It's those are sort of things that you happen upon, a bit more opportunistic. Not as institutional, not as sustainable, but pipeline is a much more important sort of valuable source of alpha for us, for our clients in the future. So it's really about pipeline. And capacity as well is again, it's different from just people or skilled individuals. Capacity is about building a team that really meshes together, works together, and functions really effectively in this kind of odd asset class, because private equity or private capital is a fairly odd asset class. So when we talk about building capacity, it's about building our ability to truly deliver alpha from the investments that we make. So underlying those two broad pillars or two broad objectives of the initiative are really four components, because in order to build pipeline, you really need to understand a lot more about the market in which you choose to invest. So we've thought a lot about our investment strategy, about the sectors that are interesting to us. Tends to be broadly around growth sectors. I think our DNA is clearly growth. Our clients are keen to support Australian growth stories, and so we've focused around we focused our efforts around growth. And we have done a lot of work internally to map sectors we're interested in, but did go out and spend some money that we were supported with in our initiative to really do a deep dive into a couple of healthcare related sectors, so the home care industry, the specialist care industry, and then beyond that into a segment of business services, which is the events industry. So we've done some really good work there, and that's been quite productive in terms of helping us build our pipeline. And there are a number of opportunities that we're looking at that have been a direct sort of output of that work over the last 12 to 18 months. Another aspect of building pipeline, and again this kind of goes over to capacity as well, is what we call our EEN. So EEN, hopefully the acronym will become better recognized at IFM, but it's our version of an operating board of a grey-haired, as a set of grey-haired individuals, as they refer to in infrastructure, I think. For us, EEN means Entrepreneurs and Executives Network. So what we looked for here, and we before we started to build this network, we took a look at best practice across all the GPs that we have invested in across the world, and there's some really good specialist GPs, more in North America and Europe, not so much in Australia, that do this, and try to figure out how they do this, what sorts of EENs they build for themselves in order to drive pipeline and alpha. And yeah, clearly we're not yet a huge asset class. So what we came up with was a concept that said, let's try and map on top of the sectors that we're interested in at least one individual that can really help us identify opportunities, due diligence opportunities, and then potentially be involved in asset management and ultimately exiting from those investments. And we've identified, and really one of the things that and I think the team is most proud of, is the caliber of individuals. So we have 4 individuals that we've appointed to our EEN, and they are really just all of them outstanding. Dean Durrell, who we've worked with a long time, over the last couple of years in our furniture platform. He has a good sort of digital marketing background and has been really helpful there. 2 fantastic healthcare industry professionals, Helen Karinchik, who, amongst other things, was a founder of Genesis Care, which is in the process of being sold. It's quite a high-profile sale process that's going on. It's owned by KKR. Robert Wise, who ran the second largest private hospital group in the UK, came back to Australia and ran a hospital group in Adelaide that was actually the group that got Calvary, that got into a spat with Medibank. I don't know if you remember that fight in the press between the largest private payer, Medibank and Calvary. So Robert was at the forefront of that and really invaluable in terms of his expertise and insight in the industry. And then Stephen Audsley, who's really fantastic around consumer goods, ran Peter's Ice Cream, Breville Appliances. And so all these individuals, and we work with them in a very systematic way. We make sure that we don't just involve them opportunistically, but we work systematically with them. We share pipeline with them. We share ideas with them and vice versa. And they've been really fantastic in helping us, again, build our pipeline and our capability. And then on to Josh's point, really, I suppose, most importantly, we've added two outstanding individuals to our team, both Stuart and David, who are Sydney-based. So together with Sri, we now have a significant capability on the ground in Sydney, which I was a bit skeptical of up front, but Brett keeps on reminding me that there's a big capital market in New South Wales, and he's right about that. So again, this is just working fabulously for us, and the team is. We took a long time to make these hires. You have to be really, really careful with a small team. As I said, capacity is about how we work together and how we deliver together, not about individuals. And so that's for those of you who've met Stuart and David and worked with them in Sydney. It's been terrific for us, and we're really excited about the team. So as we move forward, as Brett said, it's now about growing. So we've got the foundations in place. So now it's about how do we actually invest in more companies and how do we deliver more alpha. And one of the things that we felt was really important, certainly given the way that our mandate is set up with Hester, which is our first sort of new mandate for direct investing, is that we had the capability to sort of go on risk, to spend some money up front to develop conviction about a potential investment opportunity before we necessarily had the approval from our investors to spend money. So just giving us an edge in the market and allowing us to really get up the curve slightly faster on investment opportunities and be more competitive, because make no mistake, even if something we're working on is proprietary or somewhat proprietary, ultimately it becomes competitive. So you need to be able to get up that curve really quickly. So you probably should be ringing the bell. I'm sorry, I feel like I've gone over, but in summary, from our perspective and hopefully from IFM's, a great transformation, a great platform, and great growth opportunities that lay ahead of us. Thanks.
The initiative that I'm focusing on over the course of the year is expanding infrastructure. If you go to the next slide, and really there's two questions that we want to answer when we look at the possibility of expanding infrastructure. The first is, can we expand it? And the second is, should we expand it? And when I say should we, I mean, given the growth that we're otherwise delivering, does it make sense to kind of vector off in a slightly different direction? So to put things into context and I think explain what expansion might look like, I'll start with what we do today. And the graphic there is actually a target, and in the middle of the target are the types of assets that we've always tried to bring in the portfolio. What we look for, really first and foremost, are monopoly characteristics, concession length, cash flow certainty, inflation exposure, and economic growth or GDP linkage. And if you look at some of our early transactions, they're right sort of in the middle of that target. Arqiva, Veolia was a little bit exotic in the sense that we went into Poland. Duquesne is a straight down the middle utility. Anglian is a water company, and Colonial is a pipeline in the U.S. All relatively low risk in that sort of middle part of the target. Coming out of the GFC, great opportunity. We invested in 50 Hertz, also right down the middle. Lower return, but still very, very much a core asset. What we've done since then is really expand the scope of the fund quite significantly. And if you look at the size of the deals that we've done since 50 Hertz, they've obviously gone up quite considerably. Manchester at 1.4 billion, the two Freeport deals at 2.2. Both of those deals have a considerable amount of construction risk associated with it. So we really expanded the definition of what we're doing more broadly. Vienna is a listed asset. Convex is an asset in Mexico. And Indiana, the most recent deal, is far and away the largest deal that we've ever done. So as a starting point, we've very much expanded from where we were. We've moved out in the risk spectrum. So that sort of blue area is the kind of 8 to 12 spectrum. Convex and the two Freeport deals are both well outside of that in terms of return. So So we have tremendous scope in terms of what we do today. One of the questions I've been asked is, why aren't we in Asia? Is there any reason that we can't go into Asia? And the answer is no, we can. It's just that we haven't seen the right risk-adjusted return and the right opportunities, but there's no reason that we can't do that. So as a starting point, we have a wonderful platform and a tremendous amount of scope. So that really sort of speaks to the question of, can we expand and should we expand? So if you flip to the next slide. So the thinking, and there's been an enormous amount of discussion about this, the thinking is, to the extent that we do sort of vector a little bit differently, it needs to start being infrastructure-ish, right? It's got to be infrastructure-like. We can't take this team and go out and do commercial real estate because we're not going to have any credibility, but we can do things that are sort of conceptually adjacent. And what I mean by that are assets that are either very asset-heavy, they're industrial, or they're adjacent. So we own ports. Potentially we could look at things like shipping, for example. So things that sort of follow on from what we do and opportunities that we otherwise more broadly see. It would mean different risks. So it would mean assets that were subject to more competition, assets that might have either reserve or commodity risk, so assets in primarily the mining sector or the oil and gas sector, and assets potentially that are in locations that are more exotic than where we've been before. So we're in Mexico, we've looked in Peru, we're in Brazil with a legacy Pac Hydro asset, but these might be assets in places like India, Indonesia, but generally or genuinely more exotic than what we do today. And finally, they would need to have higher returns. You can go up the risk spectrum or down the risk spectrum. I think going down the risk spectrum is not a really a good part of the market, but I think there are certainly opportunities in that target sector that have got higher returns. In all cases, no matter how we approach this, the key is going to be to find the right investment. We need to find something that investors like, and we need to find something that works, because if we do it once and we get it wrong, we're not going to be able to do it again. So first and foremost, the absolute key to getting this right is to hit that green circle and find the right investment. So to progress this, there's really two tactics that we've talked about more broadly. One is the possibility of creating a new fund, a sort of core plus plus type fund. And the other is the possibility of a new offering, and sort of a separate approach or a separate tactic. The new fund is pretty straightforward. The pros of having a new fund is once you've got the new fund, you've got lots of time to execute deals, right? You're funded, you can look at deals, you can do diligence, and you've also gone through an exercise of getting clear buy-in from clients. They like the idea, they're comfortable with it, and they've written you a check. So those are the pros of a new fund approach. The cons is it's a very, very long process with a lot of hurdles. We need to get through asset consultants. There's a whole range of issues that will inevitably come up with the team, who's doing what am I looking at, what are they looking at. So there's lots of things you sort of need to work through that create some pretty substantial hurdles. Equally, it's quite likely that some clients will object. They're going to ask, what's in it for me? They're going to say it detracts from your core focus. I don't want you to do that. I signed up for core. I'm paying you for core. So I don't like this idea. And also, it's going to distract potentially from our current focus. And we're investing a lot of money. We have a very, very active deal book. Right now, I think we have more opportunities globally than we can potentially execute on, which is terrific. But it's not always going to be like that. So we have to ask the question, should we do this to the extent that it might otherwise interrupt what is otherwise quite a good business and quite a good component of the growth of the revenue for the organization. The alternative approach is a new offering. And what I mean by that is, when we find that green circle, effectively going to clients and saying, look, we see an opportunity that doesn't really fit in the fund, but we like the deal. We think it's a really good deal. We think you want to do this deal, but we can't justify this as being core infrastructure. Is that something you would be interested in doing? And my sense of that is, if you have those conversations, you'll get less resistance from clients, even if they don't want to participate. And it's like the idea, if you invite someone to your party, they don't complain about the noise. I think if you go to them and you say, we want you to come into this, even if they say no, if you go ahead and do it with other investors, there'll be less resistance. So you get the potential to get clients engaged about the opportunity, and you can start and stop with the market. And if you go with a fund approach, you really get that momentum, you can't start and stop with what the other opportunities look like in sort of our core space. The cons of that approach are some clients will object, there's no doubt. Some will object, and I think that the primary objection will come from clients who are relatively smaller and don't have the direct investment capability. But no matter what we do, there's going to be some objection. And the other con is it is going to be pretty tough to transact and organize funding simultaneously. So if we go forward with this approach, we have to bring clients along with us while we're transacting, and that's a chicken and an egg and an egg and a chicken at the same time. So it's not going to be easy. It's possible, but it's not going to be easy. So that's the current thinking about expanding the infrastructure offering. The project plan and what we're doing now is, first of all, we're pitching our capability, and we have a pending presentation to the Investment Advisory Committee, which is composed of our largest global investors, where we're going to talk about our capability in the midstream sector. That's probably where we're going to see a lot of these deals in the short term. So we're sort of prepping them to demonstrate what we've got, particularly in terms of some of the senior advisors that we've got in place in the U.S. We're starting to scope out the market of participants. So we're looking at, if we do go down the new offering approach, who might want to do this and who might be able to actually write checks. So we know when we have one of those opportunities who to go and talk to and who to circle up. We need to, over the course of the year, as I said, consider the impact on the existing business and the potential for a broader disruption. And then finally, and what the deliverable is towards the end of the exercise is a decision whether we proceed down the track, and if we do proceed, effectively selecting the tactic that will work, either in the form of a new fund or a new offering. So that's the thinking, and it really is, about addressing those two questions. Can we do this, and should we do this, given the success and the growth that we've otherwise had across the existing fund? Thanks.
Oh, quite a few faces. Okay, operating efficiency and simplification. So to keep it simple, this is going to be short, and we'll get on to the rest of the speakers. We've grown very rapidly, and in discussions with the board through the planning process this year, there was a recognition that as we grow, we will have put processes in place that may not be as efficient as they should be. And as a personal observation, as we've grown, I've noticed we've actually siloed as we've grown, because we're all very busy focused on our own particular parts of the business. Even in FinOps, which is now 60 odd people, we're siloing within FinOps. So if you take a step back and just pause for a moment and think, ooh, that's not the way we want our organisation to operate. We need to be much more collaborative. We need to re-engage around some of our processes. Then this is a great opportunity to do so. Move to the next one. So what is project simplification or operating efficiency? We had a couple of choices here. We could go out to a consulting house and say, come in. They'd take our watch, tell us the time, give us the watch back, and charge a very large check. That's what consultants tend to do. They tell you what you already know. I know that everyone in this room, and as Josh sort of described, what is the value of IFM, $450 million worth of intangible asset, which is the goodwill created by everyone in this room, that you actually collectively have the answer to simplifying the processes that we all currently do. We can't do it all straight away. This isn't like 1 week and everything's going to change. This is actually part of our culture. We actually have to get better at collaborating, improving our processes through talking across the silos, and this is across investment teams as much as between investment teams and support teams, because we've globalised. Does the London office actually talk to the US office? Does the Tokyo office actually know what the London office has promised? How do we make sure we embed that sort of collaboration and simplification, because people actually know what their teammates are actually doing? So that's really the intent of this project. How are we going to do it? We're actually going to engage, hopefully at some point, everyone in this room, because you are the people neck deep in the processes today. And I know there are many frustrations that you will have about, oh, this doesn't quite work. I won't mention DMS, sorry. Oh, sorry, who said that? No, but seriously, we actually have invested a lot of money in some core systems and capabilities that certain people may not actually even use yet because it's a little bit harder or it's not quite working the way it should be. Well, let's actually have that conversation. Let's work out what we do need to do to actually make it a little bit simpler, a little bit more intuitive. Maybe we can tweak it. Maybe we've got the wrong system and we actually have to do something else. Or maybe we're just not talking enough as teams across the silos about what I'm doing and how that impacts you, what you're doing and how it impacts me, and let's actually start to simplify that. To make that all happen, we've engaged Stuart McNamara. Stuart should be here somewhere. He's on contract. He's actually not from a financial services background. He comes from a logistics background. Spent a lot of time in his career around lean processes, process improvements, and also a strong focus on data and data governance and how data actually flows through organisations, because one of our challenges also is how the data actually moves around our organisation, how it gets used. So Stuart's going to provide a sort of a focus point. We will engage a working group. We haven't done that yet, but I want to come out to essentially every department across IFM, both globally and in Australia, and just pull together a group of senior leaders to actually be a focus point, to actually start the conversation. What are the real pain points that we think there might be some quick wins to say, if we focus on this, we can actually get some simplification and improve our processes. Hats off to GIR, Global Investor Relations. They actually put their hand up and said, we're globalising rapidly. We've actually got a lot of processes which we actually wouldn't mind someone coming in and having a good look, lift the hood up, let's actually have a good conversation. And that's actually perfect because it starts with the customer and it works its way back, all the way back to the investment teams, through FinOps and the other support teams. So starting with GIR is actually the most logical place to start. Start with your customer and work your way back. So Stuart will be working with GIR to start to work through a process around their process improvement, and it will then start to touch back into all of the touch points. How does FinOps support GIR? How do the investment teams ultimately support GIR, etc.? There is an opportunity for everyone to be involved, but as I said, this is not about 100 ideas all coming at us in the first week and then people going, well, nothing happened. This is actually, in the Olympics sort of analogy, a marathon, not a sprint, despite Bolt running later today. This is a marathon. We should be setting ourselves up culturally to just do this naturally, year in, year out. How do we continually improve our processes? And I certainly look forward to our culture, which Josh talked about, becoming a very collaborative and process improvement focused culture as well. Thank you.
Hi, I'm Josh. I'm the Chief Commercial Officer. You might have seen me up here previously. ESG. I was thinking about ESG just then and what I can use to tell you what ESG is. I'll start with a newspaper article I read post-GFC in 2008, 2009, and it was really about more regulation in Europe. And the headline was, we don't like private equity firms coming into Europe raping and pillaging our companies. Raping and pillaging. So keep that in mind. We don't want to be rapists. We don't want to be pillagers. So that's the bad side of investing. What's the good side? We decided to engage someone who's senior, someone who knows about this area, and for him to be a champion in ESG, in what's responsible investing and what's good for our investments as well as our investors. So with that in mind, I'd like to introduce Chris Newton. Chris has been with us for a month and a half, 2 months, coming to 2 months. He's reasonably new, but he brings a wealth of experience. So over to you, Chris.
Thank you. Thanks, Josh. My name's Chris Newton. I have a lot of other nicknames, but we'll just stick with Chris for the moment. I often start these presentations with a bit of a recognition and paying our respects to the traditional custodians of the land upon which we meet, the Wurundjeri people of the Kulin Nation. I say it for two reasons. One is because it's personally important to me with my own personal connections, but two, when we talk about ESG and responsible investment, how important it is as us that we recognise and remember that we are custodians and stewards of other people's money, i.e. the millions of people around the world upon which we look after their money to give them a safe, secure retirement in their future lives. Responsible investment, or ESG, I'll use the words interchangeably. I like to use responsible investment primarily because it's not just my role within the business, it's actually everyone's role, no matter where we sit, if we're answering the phone to new customers or clients or structuring a deal, or at least just even how we talk to each other. I think that's really important to remember. It's important to us not just for our own cultural foundations, but it's also important to our clients and our investors. And like I said at the very beginning, it's actually important to the people whose retirement funds we manage. They expect us to be responsible, they expect us to build local communities and to protect them for the long term. And I think that's a really critical thing. So how do we apply it at IFM? There's two real ways that we try and look at it, through policies and processes. I'll be relatively quick. I know a lot of people know a lot of this fundamentally, it's your jobs as well, and it's something that I've been really encouraged to see across the business, is that we genuinely do this day in, day out without really thinking this is an extra box to tick. It's actually just how we manage our investments and how we acquire them. So first, around the policy, this is our ethical and social values. Often we do get mandates from our clients and so on, but this is how we behave and how we think. Going to our processes, how we integrate. So how do we integrate in terms of how do we assess our due diligence processes and we assess the risks and so on and assess the opportunities. The stewardship, which is our long-term nature of ownership. How do we manage our investments to the best of our abilities to generate strong, secure, stable returns, but also great investments for those communities upon which we're acting. The last part, which we'll sort of start to focus on a lot more over the 6 to 12 months, is this reporting and communicating. Like I said, we all do it. We do it. It's our daily life. It's our part of our fabric. It's our culture. Now what we need to do is step up in terms of actually talking about the rest of the market and letting them know how we do it, telling the stories, and actually reporting on it, communicating on it. Another interesting issue is what we will try and address over the next period as well, is advocating on certain issues that are important to us, that are important to our assets as well, whether it be a diversity measure or an accessibility measure, allowing all people in the community to share the benefits of what we are managing, whether it's an airport or a port or a new private capital infrastructure investment. So with regards to our goal, and I'm really pleased to see that the goal of the strategic initiatives is now ESG leadership, and we want to be recognised as a global leader across this market. And one of the key things about this goal is actually about being, it's done by real tangible actions. It's about on the ground activity. It's not just the window dressing that we want, it's not just filling out the report. It's not the media grab that we may get. The key, let's go on to the next one, the objectives. So fundamentally, why are we all here? To enhance our investment returns. We're also here to strengthen, I think through responsible investment practices, is strengthen our brand and reputation, and obviously that'll have long flow-on effects to our business, and embed our cultural and values. I think that's critical. It's the way we treat each other and the way we work with our clients. So over the next period, there's sort of 4 areas. Like I said, it's not just my responsibility, it's everyone's responsibility in this role. Our clients expect it, our government partners expect it, and like I said, our investors or the communities upon which we operate expect it. And in fact, when we look at the workforces now, 34%, in fact, they're the largest workforce in the US and not far behind in the States, is the millennials, so the 18 to 34-year-olds. In terms of their social values, 97% of them want their money to go towards ethical and socially accretive products and investments. So you can see that the wave will be happening. We need to be ahead of the curve, And by using our people, obviously, each and every one of you, the right policy frameworks and so on, our processes, and then finally our partners. And I think about our partners as our investors and working collaboratively with them to drive more socially responsible and of course financially stable and secure investments into the future. I won't go into the last slide because I know we're running out of a bit of time, but thank you very much. I'll look forward to sharing some of my nicknames with you in the future. Over a beer, of course. Cheers.
Thank you very much. I'm Neil Carter. I'm the head of active equities now. We were previously just head of small caps. I want to share with you a couple of the slides that we went through last year. The strategic initiative was called Project Alpaca, which is Australian large cap active equities. That's how we got to Alpaca. And the idea was that we have a fabulous passive team here in Melbourne, led by Aidan, which takes care of a chunk of the large cap market. But in the active space, all we had was the small cap portion, which is about 5% of clients' equities allocation. And there was a big chunk of clients' portfolios, typically around 25%, where we didn't have a product offer. So we wanted to address that. We were at that stage, we were looking at options. We were considering a large team of 6 or possibly a smaller team of 3 working with the small cap team. And we were thinking about what kind of process we wanted, but we did want something that was style neutral, that had a quantitative element so that we'd have consistent alpha generation. We think that's very important to institutional clients. It's what we seek to do in small caps. It's what Aidan's team seek to do. And so we said at this stage last year, there was work to do, but we were hoping to do something significant. And a few months later we did. In December, we were successful in recruiting the active equities team. This team came from AMP with a very long and strong track record, very highly regarded in the market, and something of a coup for us. And I think, we were very careful not to have too much press, but everyone in the equities markets, said to us, good get, what a fantastic team that is. And it's testament, I think, to IFM's unique model that is attractive both to our investors but also to our investment talent. If we structure things the right way, we can set up good remuneration structures where the teams are very strongly aligned with client outcomes, and that's what we've done. So this team, Lachlan Davis, who's the head of the team, Mark McClatchy, been working together for 16 years. Most of the team been working together for about 10 years. Very, very strong record of alpha generation. For the technically minded of you, information ratios, around 0.85, which is very, very strong. 8 of the team are in Sydney, but we have Nick Ko up in Hong Kong. So we've opened a Hong Kong office. We have our first investment professional in Asia. I think there will be more to come there. We are expecting to get our first client win imminently. So $350 million win, and we also have an RFP out for another $500 million. Now the team came on board. The first one, Matt Salmon, actually joined in January, but the bulk of the team joined in the middle of March. The first fund was up in May, so 2 months after the team joined, and we're looking at getting our first client money in less than 6 months. That is absolutely remarkable. A lot of systems work, a lot of legal work. It's been a huge effort. And so I'll come back in a second. Sorry, I didn't realise what the order my slides were in. Just in terms of their investment process, they are a hybrid of quant and fundamental. So they take a very strong quant base, which is similar to what Aidan and Lawrence and the guys do down in Melbourne. But then they blend into that a very strong fundamental input, which is basically what we do in small caps. So it's almost a kind of best of both worlds approach. And one of the key differentiators in what they do is this kind of sensitivity analysis you see here in this chart, where they don't say, I think these shares are worth $50. They actually come up with a spectrum using Monte Carlo analysis, and that's a really differentiated product, which I think takes them above most of their competitors. Now, I mentioned that the effort to get these guys up and running and the first money in the door in less than 6 months is absolutely monumental. So wanted to say a massive, massive thank you to everybody in FinOps, in commercial, in marketing, in IT. So I don't think we do a good enough job of saying this, and there's many, 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 many names that are omitted from this, but thank you all. It has been a truly Herculean effort, and very much appreciated. And then finally, just looking ahead for IFM Equities, we now have a 23-person strong team across the whole business, across both Melbourne and Sydney. And in Australia, we have the full spectrum of the index funds, all the way down to active and large caps, small caps, and now micro caps. We've just won our first mandate in micro caps, 75 million. We got appointed yesterday for Mindwealth. We also have the Asian Market Neutral Fund. So this is part of our new active capability in Sydney. The guys, as well as doing Australia, they have the Asia Market Neutral. That's a long-short product. For the first time, gets us into the hedge fund space. That's very, very exciting. And Aidan's going to talk to you about our global capability in a second. But what we have is a very, very strong record of alpha generation and delivering fantastic customized solutions to our clients. What are we going to be doing going forward? Well, I think there's a lot of collaboration we can do across the team in terms of our intellectual property, trading. We're looking for best execution opportunities where we can swap stock across marketing, through ESG, and of course our systems to drive efficiency and productivity. And we're thinking about the roadmap. These are just some ideas, but there's an awful lot we can do with the infrastructure that we've got. And the current business plan calls for us having about 50 million of revenue in a few years' time. And the question is, how do we take that to the next leg and look forward to $100 million of revenue across the equities business? That's me. I'm now going to hand over to the most fun presentation of the day. Here's Aidan.
Good morning, IFM. So I'm here to talk to you today. Can you hear me okay at the back? I'm here to talk to you today about global equities. I can hear someone saying already, haven't we already done that? And the answer is no. We're in the process of doing it, and these things take longer than 1 year. So we're broadening the global equities capability. Namely, it's better beta time. Someone let the quants out. I don't know who. So imagine a different time in the past, a time before Pokemon Go, before Tinder, before the Dyson Supersonic hairdryer. A time when my team had hair. I can hear you laughing, Anna. I can hear you laughing. There's a serious side to this slide. We haven't got to the bottom of why there's been hair loss in my team, whether it's genetics or the stress of being in the area. And believe you me, no one's more stressed about that than Samantha and Megan. So, in this prehistoric time, IFM considered global equities. And it's worth taking a moment to review why and the reasons for it. So let's take a trip down memory lane. To support investors' evolving needs and further scale our business. Sounds pretty good, doesn't it? Well, some of the meat behind that is investors are increasingly looking towards global equities. Equities in itself is the largest asset class that our clients typically have, and global equities is increasing within that asset class as investors outgrow Australia and as they become more sophisticated and realise that the Australian index is pretty concentrated. And investors continue to focus on fees and transparency of fees. So the foundation of the strategic plan is to add value to clients and pass on the benefits of scale through lower fees and better net returns. So we consulted with the IAB. And with the IAB, we honed in on global passive equities. It rounds out the IFM commodity product offering. We did get something wrong in the business plan. We said it'd be easy to implement. Well, we got that wrong. it's actually been a lot more complicated than we first thought. But we've managed to do it, and we've managed to do it in the time frame we said we would. And in doing passive equities, we can expand into other areas. We call it supercharging them into areas such as smart beta. So this is taken from the business plan, back when we did it. So we said we'd talk to the IAB and get written in principle $1 billion of commitments from two investors. Done. We said we'd meet with asset consultants to gauge market interest. Done. There's plenty of interest. We said we'd acquire IT systems, hire new staff, set a pricing strategy for new investors. And done. So where are we today? We've gone through a few PMs since we started. And no, not because we've been slow. There's just been a lot of PMs. So again, this slide taken from the business case. We said we would start with the vanilla global index fund. We did. We always said down the track we would expand into smart beta. We are. And we said, and we didn't think we'd do that in the first year. The business plan was realistic. We said we'd do it, sometime afterwards. So, better beta. It is a key opportunity for IFM investors. We identified it back then. It remains a key opportunity. There is no shortage of surveys and media indicating this part of the market is growing and will continue to grow. But more importantly, as we talk to clients, we are seeing firsthand the interest in this area of the market. And better beta is an important aspect of the business case. This is the one slide Vinna let me keep, actually, of my original slides. So this is where we're at within better beta. We've done the discovery. We've got the IP. We've designed it. We've developed it. We're up to the point now of bringing to market. And we're getting a strong response from potential clients, consultants, and internally. We presented it to Brett. Lawrence promised Brett that we'd blow his socks off. Well, we did. We did. We did it in Brett's office. They found these in Mike Hanna's office. You can have them back, Brett. So I deliberately haven't gone into the specifics of what we've done in Better Beta. I can't do it justice in 5 minutes, but we will hold, Lawrence and Adam will hold a lunchtime session for you, and they'll answer questions such as, what is Better Beta and what specifically have we designed? So, so come along to that when you see it coming in the near future. The last slide really doesn't fit in the presentation, but I just liked it anyway. So I saw a comment this week. Who's been watching the Olympics in the last couple of weeks? Oh, gee, that's pretty poor. God. Well, when it comes to gold medal performances in blowing budgets, the Olympic Games has been a consistent winner for the last 50 years. I'll award the silver medal to last few Australian governments and bronze to Daniel Andrews. But in summary, the reasons why we considered global equities remain sound. The business case was sensible and it remains sensible. And we're on budget. So there'll be no need for this. No need.
Okay, can you please put your hand together for the leadership team? Thank you, Aidan, and all of the team. We take these very seriously, but we also joke that nobody wants to follow Aidan, and you can see why. But anyway, so thank you all. I hope that you found it interesting, enlightening, and somewhat humorous, but at the same time very serious about the opportunity we've got ahead and how we've decided to design our plan accordingly. So with that, I understand that we've got some time for questions, and I expect to be bombarded as always. Questions for the team, please. Yeah, and if you could, given that we've got people on conference, if you like, from both Sydney and Tokyo and Hong Kong, it'd be good if you could use the microphone with the barrage of questions that are now about to follow. Fire away. Come on, somebody be brave. That's good.
I'll ask Aidan. I'm impatient.
Mike, just so the other guys in the other offices can hear you.
Patient, can you describe Better Beta in 20 words or less?
There we go.
You know what? That's why Lawrence is here today.
There is no single definition of Better Beta in the market. There's all kinds of different ways that people define it. In the market overall, it's a better way of achieving a risk-return outcome than what the market capitalisation index does. The market capitalisation index may well have flaws. In terms of what we've done at IFM, is Aidan's instructions to us from the beginning were not just go and backtest stuff till you find something that works. He said come up with a paradigm. The paradigm that we have is very simple. We want to invest in companies with good earnings where we can get those earnings at a good price. And then everything else flows from that. Come along to the lunchtime presentation and you'll get details.
And take some industrial strength socks with you. Okay, other questions, please.
So question for Neil. With the 3 new active equities products, do you have caps on those?
You mean
Maximums that you'll allow in terms of
strategy capacity?
Yeah.
Yes. The 2 Australian products, there's an Aussie core product with about a 2% tracking error, which looks to do 1.5 to 2% alpha, and that's about 5 billion in capacity. And then there's an extended alpha version of that, which gets to 3 to 4% tracking error, and let's call it 3% alpha, and that's about $1 billion in capacity. And then the Asian market neutral product is also around $1 billion. So all up, call it 7.
Robin?
I had a question for Kyle. In your slide that showed the choice between doing a new fund or a new offering, you had an or. Could it be an and or? Are they mutually exclusive, or is that just a capacity constraint at that boundary?
I don't think they're necessarily mutually exclusive. I haven't really thought about both.
Can you help?
I haven't really thought about trying to run them in parallel. I think the key is, as we've seen in the past, you want to get as much momentum as possible and as much excitement as possible, and just try to avoid any hurdles that can unnecessarily slow you down. So it's possible that we'd run in parallel. My sense is it's going to be more like an or than an and, but I'm not sure at this stage.
Any questions from...
I've got a question.
Mike, fire away.
Question for Philip. In terms of the simplification sort of process and strategy, a number of years ago, Philip, we used a consultancy called Bevington. Just curious as to whether you plan to bring any external support, input, expertise, or will it be entirely sort of bottom up across the teams?
It's certainly intended to be bottom up by the teams. If we feel that there's benefit in bringing in some expertise in a particular area, then we will, but that's not the starting point.
Any questions from Sydney, Hong Kong, or Tokyo? Whilst we take one from Janice.
Thanks, Brett. Hello. Yeah. It was just a high-level question. First, has there been an interest from employees to be able to invest in any of our products? And if there is there an opportunity to do so, especially for the more liquid asset class?
The answer to the first question is absolutely yes. There's an enormous amount of interest, as I understand it, from employees to be able to get access to the capability that's damn good. Hopefully a number of us are doing that indirectly through the funds that we're otherwise in, but I take your point in any event, Janice, and we are working on that, and it's a very good question because I'm not in a strong position to be able to answer it at the moment. So Josh looks as if he's going to take that one.
A step at a time, Janice. So we are working on a couple of opportunities with Neil's team. We want to expand that to other asset classes. So my aim is that by, let's call it, end of this financial year, we'll be in a good position to have all asset classes, employees in all asset classes invest into their own products, at least. The challenge that we are currently facing, and I don't want to tell you our problems, but there are actually roadblocks. There are actually regulatory roadblocks for us. We have to make a decision whether or not we offer the products to everyone in the organization, because we cannot under our licenses. If that's the case, how do we quarantine or segment? I mean, it's I think a pretty fundamental question that we need to answer. That's why a step at a time, James.
Thanks, Josh.
I think this is more for Neil. Given we are expanding in the active equity space, are we thinking about an exposure towards listed property?
That's not on the agenda at the moment.
Well, that wasn't a duck or a weave. Good, like straightforward answers. Whilst we're on that, one thing that we are contemplating is that as our clients go global in all of their asset classes, including global property, again, to Kyle's framework, can we, should we, how would we potentially go into global property, direct, not listed? And so we are having, confidentially, so please trust with a couple hundred people, we're having a confidential conversation with ISPT, given our global expertise and our global reach and our global network and our capability in direct investments, albeit non-property, and ISPT's capability in property. Can we, should we collaborate with ISPT to potentially build a global property direct investment capability? That's at the early stages. It's quite confidential. We've been engaging with our shareholder advisory board on their potential demand for that and their philosophical interest in it, but clearly subject to a whole range of technical and other things that are being worked through at the moment. But in the interest of full disclosure, that is something that a small number of us are contemplating on the direct side. But I would appreciate that isn't something that I read on the front page of the Financial Review tomorrow. Other questions?
This question is for the debt team, infrastructure debt, so either Kevin or Scott. Are we going to be considering in infrastructure debt investing in Asia?
Thanks, Lucy. Not in the immediate future. We did spend some time a few years ago looking at the Asian opportunity set for debt. And at that time, we thought that we had some better risk return opportunities here in Australia and also in the sort of the OECD infrastructure debt landscape. So that's focused in North America, focused in Europe at the moment. But it's obviously in our neighbourhood. It's close by. I think there'll be a time where we'll look more closely at it. But we continue to engage with people in Asia. We were talking to some people from India recently, so it's not off our horizon or off our agenda, but it's not immediate.
Thank you, Scott. I have just been told by Vinna that we do have to wind up, so let me do so. We have had, and if you read that year in review, there's a table, I think it's page 3 or page 4, that shows what this team has achieved over a long period of time across, first and foremost, investment returns, but also a range of other dimensions in terms of clients and revenue, and the valuation of the firm, ISQ, MySay. This team has and continues to do a world-class job in executing, if you like, delivering above expectations that we set of ourselves. So thank you for the position that we now find ourselves in. As I said, today's been about then thinking about what tomorrow could and should look like, given that together with the execution capability and the skill that sits in this room and the other offices that we've got around the world, is also residing in an organisation that has a model that is truly different, because we are owned by those 29 industry funds with a culture that distinguishes us and an alignment that is much stronger than pretty much every other fund manager around the world. So we've got a fantastic team that's doing a wonderful job sitting in a model that is clearly distinct. And today we've got 197 institutional investors that think like us and allow us the luxury and liberate us to do what we think is the right thing to do so as we can optimise their returns. So fantastic team, differentiated model, world-class aligned institutional client base. We have, as I hope you've seen today, also now have a very clear plan that is conscious of the things that we think could hurt us and indeed help us. But as I said, we believe that on balance there is a great opportunity for us to help us, and in so doing, get to a place where we're adding greater prosperity to the people that we serve around the world, as the investors, as the working people, and in the communities that we invest in through both the listed and unlisted assets. So I hope you can see that clarity. I hope, like as always, you line up behind it, and I hope that this time next year we're standing in the same position saying, what a cracking year. And what are we going to do again? Because there is just so much opportunity for us to add to the prosperity of working people around the world, and we're doing that in a world-class manner. So thank you for all that you have done, your input into enabling us to discern this plan and develop this plan, and game on. So let's get back onto it, but thank you. If there are things that you want to discuss or whatever else, then please take the opportunity to do so with I or anybody else through the organisation. It's really important that we have your understanding and we have your support, as we have in years gone by, and your buy-in, and I think with that we should be able to continue the execution in the world-class manner that we've been able to do for years and years and years. So thank you, and enjoy the rest of the day. Again, please thank the leadership team, which also includes a range of other people, Tanya and Valentina and Annabelle and Brian and Rich, but thank you in particular to the leadership team that's also presented this morning. So thanks again. Well done. All right, back we go. Thanks Tokyo, thanks Sydney, thanks Hong Kong. Enjoy.